The TSX down today slightly after reaching record highs last week. Let's bring in Michael Dehal. He's a senior portfolio manager at Dehal Investment with Raymond James. What do you think, Michael, drove the TSX up last week? A couple of record highs.
Yeah, thank you, Marilla. A couple of record highs last week on the back of gold. Gold's been hitting record highs multiple times this year, especially last week. And I think with gold and resource equities have been pushing the TSX higher each day.
Okay, let's also talk about job numbers, both Canadian and American job numbers coming out as well. Both of them were weaker, losses in Canada, as you know. How do you see this working its way through the market? Is that perhaps a little bit of what we're seeing today with the weakness in the TSX?
Correct. I think in Canada, we lost 65,000 jobs in August following a 40,000 job loss in July. So that is definitely giving investors more confidence of a Bank of Canada rate cut in September, following another rate cut probably in December as well, right? So you're seeing weakness in the equity markets due to that. And also you're seeing Q2 GDP contraction in Canada. We contracted about 1.6% in Canada in Q2. So that's fueling a lot of uncertainties across businesses and industries in Canada. If you look at the U.S., for example, the U.S. did only gain 22,000 jobs in the month of August, far below expectations, what the street was expecting. And this week's CPI and PPI numbers, that's what investors are looking at to see if there's any signs of stagflation in the U.S.
How are you adapting your investor strategy as a result of what we have seen just last week with the job numbers and, as you say, with the expectation that there is a cut from both of the banks?
Yeah, we are seeing underlying weakness in the economy, both in the U.S. and in Canada. So the labor market is definitely weakening. So with investment portfolios, we are starting to trim down on equities that have definitely run up in the early parts of 2025. Managing risk in this environment is the key thing. Rotating into bonds, fixed income. If we do see rate cuts coming in 2025 in Canada and the U.S., bonds will do better than equities in that type of environment. So we're telling investors, stay the course, however, manage your risk as well.
Are there certain sectors that you prefer right now?
We still like sectors such as we still like tech, but you got to be selective within tech. Cybersecurity is an area that we do like in technology and other sectors within tech. Software is another space that we do like in technology. That sector hasn't performed as well as semiconductors. And other sectors, we do like staples, healthcare as more of a defensive. If the markets do rotate out of growth into more value sectors, healthcare and staples should fare well.
You like tech, even though it's been on a rampant growth course for some time. Would you pull back a little on the tech right now, as you mentioned, trimming some?
Yeah, I would trim down on the equities that have run up quite a bit this year, especially since the lows of April, and rotate into other equities that still have good earnings growth. Remember, tech is the sector that still has double-digit earnings growth, and some companies are still growing at 15 to 20% EPS growth quarter over quarter.
And when you talk about tech, are you talking sort of outside of the big seven, which some say are sort of the valuations are too high and they're worried that some of that might sort of drag the stock down? Where would you put your money?
Yeah, exactly. I would say outside the Mag 7, the valuations are stretched. If you look at the likes of Apple, Microsoft, even NVIDIA has been trading down since the earnings report of last week. I think investors are becoming more cautious on valuations. They're seeing some similarities of late 2021, where valuations did get stretched, and we've seen that sell off in 22. So within tech, there are definitely areas, like I mentioned, software, even certain cloud companies that are still undervalued, or some areas of attractiveness.
Yeah, one of you mentioned was cybersecurity. You like Palo Alto?
Absolutely, yeah. Palo Alto, great. It's one of the largest cybersecurity vendors in the world. With the recent acquisition of CyberArk, they do enhance their cybersecurity capabilities as well as AI. Revenue growth is over 15% year over year, and they're expanding into 180 countries globally. And their cash position is $8.5 billion, so they can reinvest that into their operations and other initiatives as well.
What about the Costco pick? Is that sort of just on that flip side, more of a safety pick for you?
It's a bit of both. Safety and growth. Costco, they're growing their stores, locations, 20 to 30 new club stores each year. They do have a strong financial position, strong cash flow. In North America, 90% of their members do renew their memberships each year. And if you go to Costco, but every time I go, there's huge lineups, and people overspend at Costco.
It's hard not to, I guess.
Exactly.
Yeah. All right, Michael, thank you for coming in. Appreciate your time. Michael, Senior Portfolio Manager, Dehal Investments with Raymond James.